recording. Okay, guys, so I'm going to start off by asking if there is any questions from anyone regarding any of the previous lessons.
Oh, yes.
Emmanuel, go ahead.
Yes, good morning, everyone. It's about the HRLR and LRLR that we were discussing last week.
Okay. So what is the question?
Because when we consider the HRLR and the LRLR, what's the difference? Because I see on the chat group some of you just mopping up the chart with the LR and not with the LR.
Okay, it's a good question, Emmanuel. So I'll address that because there has been a lot of questions asked to me. And the reason why most people probably would have marked their charts up with just the low resistance liquidity run is the reason that that is the favorable trading condition or characteristic of the chart that we want to trade. We don't want to trade a chart preferably that is high resistance liquidity run, because we want to be trading in the direction of the order flow. We want to be taking trades that show expansion. You know, you don't want to sit in a trade for or through consolidation. So taking trades on low resistance liquidity runs is better. Why? Because firstly, it is less structure. That's one of the key characteristics of the low resistance liquidity run. And also the fact that a low resistance liquidity run was created, especially, you know, we're not talking like 1 minute charts or 5 minutes. We're talking, you know, 1 hour, 4 hour daily, higher time frame stuff. We're not so focused right now on the 1 minute charts. Okay, so less structure makes it easier to identify the order flow. Okay, so the reason, Emmanuel, is whenever there's some kind of we could say consolidation, right, or many highs, and price expands away from this high over here, we say that above this high is high resistance liquidity run. Okay, because it requires a lot of money from the institutions to push price back up there. Okay, and we can see that price made a low resistance liquidity run by running out these stops of the swing low over here. Okay,
Right.
so it showed low resistance liquidity run here, but at the same time it created a high resistance liquidity run over here with this structure at the top over here. And then again, price made the swing low, traded through that, and then because it took some liquidity, possibly traded into maybe an order block on another time frame, then it showed a retracement. So then price retraced, only to trade back into an area of inefficiency, as we see over here with this sell side imbalance and buy side inefficiency. Okay, and again, price then made this swing high, this structure over here, and then expanded again, not only through the low over here that was recently created, but the low over here. So that's sort of a shorter term low, and this is an intermediate term low. And then price expanded through, took the liquidity, retraced. What did it retrace into? Well, the order block, the void over here, and a little bit of this liquidity before again showing expansion to the downside. Again, raiding out the liquidity over here, low resistance liquidity run. So that is a favorable trading condition. Okay, because if we think about what a price swing, like what we spoke about, what a price swing is, where we get that 4-bar candle move, okay, and it makes an old high and it moves away from that old high, it's making an order block, and then from the order block and the old high, we're getting an expansion, and that expansion is likely to create some kind of void, like we've learned or should know what a void is. Buy side inefficiency or a sell side inefficiency, fair value gap, liquidity void, you know, they're all the same thing. But that is what we are looking at here. That's just an identification that makes it easier to follow which direction to trade, because it's all very well we come and sit on the chart, but is the chart that we are looking at creating these low resistance liquidity runs for us to have favorable trading conditions? Because if it's creating a low resistance liquidity run, all we need to do is be patient for some kind of retracement, only for expansion in the same direction lower. Okay, so that is an example of a low resistance liquidity run versus a high resistance liquidity run. And then it's obviously depending on what time frame you're looking at, price expands down, and obviously there's no side to the left over here, but it would have taken liquidity, and then price would have sort of traded and retraced back up into this low resistance liquidity run before expanding again. And here we can see underneath all of these lows over here, these swing lows, price just expanded straight through it. So this makes a low resistance liquidity run. Now there's two conditions here where we could either take a buy to close the inefficiency, or once the inefficiency is closed, we can take a sell, because just as a buy side imbalance or a fair value gap is a reason to enter a trade, it can also be a reason to exit a trade. Okay, so that is the identification over here. And then this is the one that most people took heart to, and that's pretty easy to see every time there is structure over here. And I'm not showing patterns or head and shoulders, even though you could probably see it if you are familiar with those things, or W or M patterns. That's not what I'm showing. I'm just showing where there is more structure, it is more difficult for price to come above those areas unless there is some kind of big news event or interest rate decisions or something that provides more liquidity or injects more liquidity into the market. So when price expands through the lows here, we can see that what is it really doing? Well, it's expanding away, raiding this liquidity of the low resistance. Because why is it a low resistance? Well, when it took out all of this liquidity, it didn't have much resistance when it ran down. That's why we refer to it as a low resistance liquidity run. And then, well, it would have consolidated over here, and out of that consolidation, it would have expanded, and then price just retraced, only to trade back into, this is probably a lower time frame chart, and then a higher time frame would have suggested that they would have bought and then sold, and then possibly there even could be an order block over here, possibly maybe a void, or maybe even you can see here there's some kind of liquidity grab on these swing highs here. So I'm not showing you those types of things here, I'm just showing the identification of a low resistance liquidity run. You can apply on top of what you learn in the future with like breakers and mitigations and propulsion blocks and order blocks on top of the low resistance liquidity run, favorable trading condition. And then you can say, well, if this is a low resistance liquidity run and price now retraces, what is it going to retrace back into? So let's just look at actually maybe a live example over here. So this was GU. So I mostly trade EU and GU. That's my preference, but I'm not stopping anyone from trading anything they wanted. So we said that this little guy over here was the order block over here. Okay, so this up close candle makes this swing high up top here, which is there, and there we go. We have order block, swing high, hold high, expansion, and when the price expands, probably takes some of this liquidity over here and then stops going lower, and then it retraces. So what has it done? It's basically, if we look here, every time there is a swing low over here, what is it doing? Well, it made that swing high, it retraced and expanded through this low. Boom. Expanded through this low. Boom. And then what did it do? Well, after expanding through these lows, because there's liquidity there, it would have grabbed the liquidity and reversed on another time frame, but on another time frame it's retracing back into some kind of premium, only to go and sell again over here. Well, what do we say is it expanding into or retracing into? Well, we can say that there's that order block that we marked up here with this pink line, and then boom, price decides to trade up into that zone. So that's part of one of the exercises actually that I gave you, or homework or project, whatever you want to call it, that this is classified as a low risk entry specifically. So this little guy over here is our order block, and we said that the opening price of this is 19,185. So this is how I would essentially do it. Make this blue, put this as a dotted line, and 185 was the opening price. So now we know exactly that that over there is the opening price, and we've marked it up as a daily order block. So the purpose of a low risk entry is to identify bullish or bearish daily order blocks, and when price trades into them with a pairing of liquidity either to the buy side or to the sell side, in this case the buy side, because we're looking at a bearish order block, so we're looking for buy side liquidity grabs, and we are looking then towards the lower time frame over here. So what do we do with this? Here's our order block. We zoom out here, we can see the order block over here. Here's the order block. So all of this buy price action, you can put the day separators on over here. So you can see that all of this is up close candle, and then this is a whole day's worth of data, or even 2 days. There's that doji looking candle. Here's the up close candle, and then boom, price trades through it. So that's why this area over here becomes the order block, because there's the open of the day. And if you look at how it looks on the daily, there is that order block up close candle getting traded through, boom, to the downside. And then if you look at that on the 15-minute chart, that's essentially the structure that we see. And then what do we see from that day? Well, today is Friday over here. So this is Friday, Thursday, Wednesday, Tuesday, and a little bit to the left over here is Monday over here. So basically price over here opened on Monday, price traded lower over here. So Monday would have made some liquidity over here, and over here. So there's relative equal highs right in this zone over here, but this high and this high, and then over here, this high over here. So initially, price traded into this liquidity pool, because there would be liquidity over here as well, even because there's a little bit of a consolidation over there, and above a consolidation sits liquidity, and then boom, price decides to raid up into this liquidity pool over here. So we're not really focused on this price action over here, okay, because there was this move down over here, and this move down over here is the actual move that we are looking at over here. So there is a liquidity pool over here, and boom, price decides to raid this liquidity pool. What does it raid into? Well, it takes this low, takes this low, and it takes that low over there. Okay, and then boom, price decides to drop over here. So this is a good example of a low risk entry where it grabs the liquidity, and then boom, one more time it grabs the liquidity and drops. So there would have been an opportunity over here, and I think this move over here was about 50 pips. This was actually the London Open over there. Let's have a closer look here. So this was the 10 o'clock candle roughly over here. So my time, 10 o'clock, sort of around there is the London, which is this candle over here. And we can see it's coming up, raiding out this liquidity, trading into this daily order block of this blue line, and then boom, price drops. So like sort of from this area over here, 10 o'clock, which is that candle, all the way down is about 50 pips, 54 pips, and then boom, price decides to reverse and again come above this high. So essentially the order block is telling us to sell, and we are using the liquidity pool to get into the trade. So we shouldn't be selling because of an order block or a void. We should be selling above the highs because we are using the liquidity pool on the lower time frame to take us into the trade. Why? Because above these highs sits buy side liquidity. So buy side liquidity is buy stops, for example, and those buy stops are buy orders. So we are selling to those buy orders, because for every buyer there's a seller, for every seller there's a buyer, and we are selling to those buy stops. That's why we say buy side liquidity, and we are using the order block that was created on the higher time frame to give us that sort of high time frame idea or price action, and then we see it raiding up into this liquidity, and then price sells. Well, you say, well, this is so small. It's not really. I mean, if you're taking a trade over here and you're watching price trade up above these highs, because this was the high of the previous day over here, price decides to raid 20 pips. 20 pips is between 10 and 20 pips is generally a sell side or buy side liquidity raid, and boom, price decides to reject. So somewhere over here you'd be looking to sell this and placing a stop above this high, any of this price action over here. Maybe you went down to a lower time frame. Let's have a look of a 5 minute. So sort of really you're looking at this price action over here to sell with a stop above this high because it's already ran out the liquidity, and you'd be targeting any sort of low or void that gets created because those would be your institutional reference points. So anything from here down, let's sort of take the middle of this and go down. So I mean that's 40 pips. It doesn't sound like a lot of pips, but that could be the entire or half the week worth of pips that you require to make money. I mean, some of you, I don't know, if you're trading a demo account, one lot trades, that's $400 right there on that order. You know, if you're trading a 50 lot, well, then it's $200. If you're trading a 25 lot, then it's like $100. So it's really up to you guys. We're not trying to catch thousands of pips, even though it's great to catch these moves over here and over here. For this is 100 pips, I think, or 110. You know, it'd be great to catch big moves like that, but you don't need to. You just need to catch what you see in the marketplace, and that's all you need to do. You don't need to catch thousands of pips each week. 50, 100 pips is more than enough money to be made, you know, especially when you know what you're doing. And that's an example of a low risk entry. Does anyone have any questions about a low risk entry? See, Temetope, you have any questions, Temetope?
No, that's all good for me, Darren. Thank you.
Okay, do you know and understand the purpose of the exercise? Not for you to now this is your strategy. It can be in the future if you wanted it to be, but the purpose of it is like sort of the beginning stage of having something to work with.
Yeah. Yeah. I was just gonna ask that exact question. Like, is this on its own, like a daily like strategy? But yeah, you just answered that. So thank you.
Okay. Yeah, well, it doesn't have to be, but it can be a strategy or one of the strategies that you potentially would like to use. But this is like a stepping stone to other strategies because this way of thinking is applied to many ICT entry techniques. So when you can understand like buying at a liquidity grab or selling at a liquidity grab backed by like some kind of high time frame, then that flows into how you can manipulate or use the other price action models to your advantage when you can understand what's at play here, because we're trading based on price being bearish because of the daily order block, and we are using the liquidity pool to take us into the trade. So we wouldn't be, you know, selling the order block. So like there's a void over here and we try to sell this and they say, oh, well, it's just tested the order block. No, we would put our stop inside of this buy side liquidity over here.
Yeah.
And that's how we would trade. We would be really patient and wait. And sometimes we wouldn't get an entry, but it's rather to be patient, not get an entry, than just take an entry because of the FOMO part.
Yeah.
Uh,
Makes sense.
Ibakaran, I see you have your hand up. Go ahead.
Hi, Darren. Am I audible?
Yes, I can hear you.
My query is, so this LR, right? Whatever you have said. So you're saying that's very, the risk is very less on that LR liquidity rights, right?
Low resistance liquidity run.
Yeah. So that low resistance liquidity right. So basically in that low resistance liquidity right, every low is being mitigated and the highs are always same, right?
Well, it could be the high or the low, depending on if you're getting a low resistance liquidity run from a premium or a low resistance liquidity run from a discount, because you get a bullish version and you get a bearish version.
Okay, so my query is, so on the bearish market, low resistance liquidity run, it is a favorable condition for a trader, whereas in bullish market, high resistance liquidity run, that would be very safe, right? Because in bullish market, every highs will be always mitigated and newer highs will be always formed and the lows are stays protected.
Yeah, essentially. And also you must remember that on its way down, so like if we look at, for example, EU over here, what is it doing underneath all of these lows? It's expanding straight through it, right? Over here. So we could
Correct.
immediately associate that because of this expansion, okay, not because we are selling over here like a retail trader with sell stops, but it's showing willingness to expand straight through without reversing underneath sell side liquidity. And every time after that, every time there's a swing low, look at that. What does it do? It expands straight through it, right? And again,
Mhm.
expand straight through it. What's happening to the highs on its way down? They are left, like you said, unmitigated, right?
Yeah.
So every time there is a swing high, that's left. But every time there's a swing low, what's happening to that swing low? It's just being expanded straight through. So it's suggesting, it's tipping its hand to us that it is a low resistance liquidity run. We refer to it as a low resistance liquidity run is because there's not much stopping it from just expanding in that direction. Because what we would normally think is that if there is a low like this over here or a little swing low, depending on whatever time frame, 1 hour, 1 day, 1 week, 1 year, we would have a reason to think that if it trades underneath the lows, there should be some kind of reversal, right? But that's not happening. It's expanding straight through it every time there's a swing low. And here again, even here, it expanded straight through. So that price action tells us that once it's expanded through there and finds a new low, this new low will retrace probably to expand again. It could reverse and completely just go higher. We don't know that for certain. It could have just retraced straight up. But it does tell us a favorable condition to sell over here. Still applying a entry technique. You're not just trading, oh, okay, I'm just going to sell now because it's expanded straight through here. No, it's expanded straight through there. We do want to sell, but we want to wait for some kind of pullback so that we can sell. That's what we're saying, because on its way down, it's creating these structures, which makes it high resistance, and it's going to require a lot of money for price to stop and go for this liquidity over here.
Yeah, right. And the other query is, so the market cannot be always bearish, right? At one point of time, a new low that is formed, it is going to break the previous high. Is it possible to predict that?
So like for example here, it's traded lower here, right? And then it's made this swing low here. So what you're asking is, can it break these highs over here and possibly this high here?
Yeah. And so after that, the market will return to bullish bias. So is it possible to predict whether the liquidity that is being uh, grabbed, right, it's going to be strong and it's going to break the previous high, whether that can be predicted?
So this is essentially the foundation, Sivakran. You don't have right now enough knowledge to tell you what that answer to that question is. But that answer to that question will come later on when you learn more about price action. All we are looking at is how to identify a favorable trading condition right now. We are not trying to say or predict which high is going to be reversed and which low is going to be reversed. All that we are saying is, are we in a sort of sell model or are we in some sort of buy model? And we are doing that using low resistance liquidity run and a targeting of a continuous sell stop scenario. Because you can see every time there's buy stops, the sell stops are targeted. Sell stops, buy stops, sell stops are targeted. Buy stops, sell stops are targeted. They are not taking a lot of the buy stops. That tells you a little bit about the order flow, especially on 15-minute, 1 hour. What is the scenario? Are they targeting more buy stops? Are they targeting more sell stops? Because that will allow you to go into a higher time frame and tell you which direction is, allowing you to be the order flow. when you learn more, Tivakaran, like about a breaker, possibly a mitigation, those will help you. And I'll give you a little tip right now, which is something we'll probably learn later on in this lesson. We have what we call a mitigation over here. So let's say that this over here took out this liquidity over here, right? So there was liquidity over here. And if price now has traded higher over here, and it wants to then trade lower over here, but fails to take out this low and takes out this high over here, potentially, okay, this is then referred to as mitigation, because this is a mitigation over here. And then what do we expect from that? Well, then because of this mitigation, price would likely retrace into near or around that zone. And then because the mitigation has been created, and we're referring to the higher time frame because the 15-minute won't tell us that. So we're talking 4-hour, daily, weekly. If that mitigation is being created, then this whole liquidity, low resistance liquidity run that has been created is a likely target for price to trade back into once that mitigation. So that's a condition of a low resistance liquidity run, is that when we get a mitigation block, the low resistance liquidity run that was created can be then targeted.
Okay.
But yeah, you haven't learned about a mitigation, and you will learn about it. But I'm just saying that you just asked a question, and that could be a potential answer to it, based on a mitigation block. But yeah, when you learn about a mitigation block, it will probably make more sense.
Okay, Darren. Thank you.
Anyone else got any questions about a low resistance liquidity run or a low risk entry? Anyone? Okay, good. No more questions about that. Perfect. So I'm not going to spend more time on these then. We are going to move on. So what we are going to move on to is first over here, this section here, where we're going to learn about the anatomy of the different order block types. Okay, so hopefully we all should know what an order block could look like. Okay, so let's just practice here quickly, refresh our memory. Let's get a fresh chart of whatever, and let's pick first a lower time frame and then a higher time frame. Okay, so like we said, I'm not showing you exactly what it is, but first we say, for example, a bullish order block, the lowest down close candle with the largest range measured from the high to the low using the open and closing price. Obviously in a discount if it's a bullish order block, and in a premium if it's, or let's just write that there, if it's in a sell setup. So bearish order block in a premium or a bullish order block in a discount. And it is, for this example, we're just going to do a bullish order block, and it is what? The lowest down close candle with the largest range measured from the high to the low using the open and closing price. Okay, open and closing price. Okay, what does that mean? Well, okay, easy. Highest and lowest. So let's do the bullish one first. Okay, so the largest candle's range. So now let's look here. Well, this is a candle grouping over here that has a 2-candle sort of idea, but we are looking for the largest candle over here. So you can see that there's a wick over here on this one, and this one has a larger body. So generally the idea, if you've ever watched that other YouTube video about candle grouping on a lower time frame like this, we can essentially say that these 2 down candles here form an order block over here. And really you can narrow that down, like if we went to a lower time frame on a 1-minute chart, for example, over here, we could narrow it down further because we are looking for the lowest down close candle over here, which would be this one. Lowest down close candle from the open and closing price, not the wick. Yeah, the wick is sensitive, we can use the wick, but to identify the actual order block, we are looking at the closing an opening, or the opening and the closing price. That's what we're looking at, okay? And then we are looking that if that order block had been created, we want to see an expansion away from that zone. So it's not an order block right there, it's not an order block, it's not an order block, it's not an order block, boom, here it's an order block, until this guy over here was created with this move to the upside by expanding higher over here and closing above here. This then creates the order block. So it's not an order block down here until we can see it on the chart over here. We can use other scenarios to anticipate it being an order block when it gets here, but at that skill level, it's not for this lesson. We are just looking at the actual just anatomy of the order block. So although on the 5 minute we said that there's 2 candles over here, you can group candles together, you can group multiple candles together on multiple time frames, but just know that, for example, if this is a 5 minute order block we've identified, you could narrow that order block down to this one over just like that. That is a 1 minute order block like that. Okay, that is our order block over there, and there was a void created over here. So we could say that when this void over here gets closed, we can anticipate maybe some kind of reaction off of that zone. Okay, and then it's the same. Obviously, that's a bullish version. If we go to the higher time frame, we're looking for a swing that created this low over here. So obviously there was a swing over here, boom, it sold down, made this low. So somewhere here is an up close candle over here. So we are looking for the last up close candle sort of in this range over here, where this move was initiated over here, because this is sort of an origin of, you know, low resistance liquidity run, at least on this 5 minute time frame, and then price sort of retraces, as you can see, into this zone. So we are looking sort of in this array. We could call it an array from this swing high down to this swing low over here, and obviously there would be like an equilibrium, and then this would be the premium of this particular 5 minute range we are working within, and we're looking for the order block over here. So generally the order block, we could say, is the largest up close candle, and then preceded by a void. So I don't really see one over here. I do see multiple up close candles, which would be the largest ranged bodied candles that are the highest, which would be these two guys over here, like that. Over there, these two guys. So really terrible price action, but anyway, those are the two largest up close candles that I can identify. Over here, we could associate probably even further price action to this if we were to go to other time frames, but let's not do that. Let's just look at this particular time frame, so that if price was to retrace back into this order block over here, we would want to see potentially something reactionary happen around that zone, and we actually do see that. And then, you know, if that's an order block, boom, over here, this is potentially another order block, and actually this can flow into something that I'll teach you later, but we could call this over here a propulsion block over here. This is what we refer to as a propulsion block. Now, obviously, this is just a 5 minute time frame, but we could say that this is a propulsion block, and a propulsion block is basically just a second order block created off of the first order block. That is what we refer to as a propulsion block. There's more details when it comes to a propulsion block of what is it, what's the characteristics, etc. But we could just say that that is a propulsion block, and you'll learn and get the notes and, you know, a whole lesson or whatever about propulsion block. But particularly, this is a propulsion block off of this order block. So when price, you know, over here creates this order block, closes this void, if we zoom in there, closes this void over here, that we can anticipate price to again sell off over here. And obviously this is a 5 minute time frame, so the reaction would be possibly to close some of this void, maybe, because this would be an institutional reference point over here. This would be an institutional reference point. So void, old low, order block, those are your, you know, institutional reference point. So as much as this is a reason to get in a trade, it's an institutional reference point of an order block. An institutional reference point can be a reason to exit the trade. So basically, you could trade from order block to order block, or order block to void, or void to order block, or void to old high, or old high to order block, sort of internal, external range liquidity over here. So which sort of leads me to the next phase over here. So we're looking at some order blocks, and we could say that there's liquidity now over here, above this high, and above this high. And looking at the price action over here, there's liquidity below here. So there'd be liquidity over here. This would be internal range liquidity because price had come from this high down, retraced, expanded down again, retraced, failed to take out these highs. So there'd be liquidity over here. This would be internal range liquidity. And if price was to come in here, we could look to target this external range liquidity over here. So internal, external over here. So there we can see price rated this external liquidity. One time frame's external is another time frame's internal. Okay, so just like you learned about, one time frame's consolidation could be another time frame's expansion. One time frame's reversal could be another time frame's retracement. Same sort of thinking over here. This could be 5-minute external range liquidity, but on like a 30-minute or a 1 hour, it could be external or internal. It's sort of just changed based on what time frame you are looking at. So if we were taking this internal, we would target external. This would be external range liquidity over here. You target from an internal range idea to an external range idea. From an external range idea, you target an internal range idea. So what is an order block? So it's back over here. To make a valid order block, we must see price close above this high or below the low if it was bearish. We can then trade or place an order when price returns to the opening price of the candle, or the 50% referred to as, like we know, the mean threshold, the halfway point of the order block measured from the opening and the closing price, not the wick. We're not measuring the wick, we're measuring the body 50%. Okay, and either we can take the so like I said, mean threshold 50%, body, not the wicks. We are looking at opening and closing prices when we are referring to the order block. And to make a valid order block, we must see price close above that opening or closing price, depending on if it's bullish, bearish, etc., etc. We'll learn more about things relating to order blocks as we move on in the list of objectives we need to accomplish. But as part of the order block, we need to have some kind of price displacement, like a void. What is displacement? It's the void, whatever time frame, 1 minute, 5 minute, daily. Obviously, the higher the time frame, the more solidified the trade idea would be. If, looking at a 1 minute order block and a void created, that might be irrelevant based on the overall picture of where price is going. Not saying it's irrelevant, but it might be less relevant, especially if it's a bearish order flow on a high time frame and you're taking bullish trades. Okay, so it's important to understand what is the context of the market, and if your high time frame bias is bearish, then obviously you can use the lower time frame, but then selling in the direction of the higher time frame. And to identify a proper order block, it's not just every single engulfing candle like many people think it is. It is an engulfing candle preceded or after the fact that it's created, followed by a void. So there must be the order block, and if it's the order block, there must be the void to show institutional sponsorship. That is showing institutional sponsorship with a void created. And oftentimes, price may look like it's created an order block. It's engulfed the candle and there is a void, but we must understand what is the context of the marketplace, because they might want to create the order block down there, but that order block is bullish, and if price retraces into it, they might trade straight through that order block because they've already retraced to the higher time frame to expand lower. So that was just a case for price to buy it into a premium and then continue selling it. So we must understand the context of the market, what the bias, the overall bias would be, so that we can associate if the order block we are trading is a likely scenario. Okay, so if we are entering a trade on a specific order block, before we place the order or take execution, however you want to trade it, either you put a limit or take an execution when it gets to the zone, we should know where our stop loss is and where our exit is. Okay, so again, that can be placed on specific levels like an institutional reference point, an opposing void, an opposing order block, an opposing old high, an opposing old low. Sort of those are where we would take profits at. Okay, so if we look at what price would look like, price decides to buy, and then price decides to sell. So what we're essentially saying is that this is an up-close candle, or many up-close candles, depending on if it's a 5-minute, 4-hour, 1-hour, but that is a sort of upward move, and then we get the downward move over here. And basically we're saying that this is then created the order block over here at the opening price of that entire candle, whether it be a 4-hour or a daily. Okay, so what is it essentially saying is that if there was some kind of maybe, I don't know, swing of price action over there, it has expanded through that zone, which would also have liquidity there. So in a way, there's some sort of play on low resistance liquidity runs over here as well. But we're not looking at that right now. You can associate that later yourself in practice. But essentially what we are saying is that it is expanded over here so that if price returns back over here to this opening price, because there is a void and the order block, not just because there's what we think is an order block, there must be some sort of expansion, is that if price returns there, we can expect a further move to the downside. And because this is the swing high of the low of the high, and this is the swing low, and price should return, then this is external and external. So over here, IRL, because this is the range we are currently in, and over here is ERL, which stands for external range liquidity. So generally an order block is internal range liquidity, and if we're taking a trade idea based on internal range liquidity, we would generally target external range liquidity. So an order block is internal range liquidity because the order block could be sitting over here at the purple line, or maybe depending on what time frame you're looking at, up here maybe. But either way, it is internal range liquidity. And if we are taking the trade based on internal range liquidity, our target is external range liquidity. Okay, and that same is said for if it was an order block, if it was a void, anything. So over here would sit the old high, which is external range liquidity. Internal range liquidity is the order block and the void. So when you're trading an order block or a void, that is internal range liquidity. And if you're buying into that and you close your trade, then good, trade idea, great. But if you're looking to take a trade based off of the void for expanding price lower, you are targeting external range liquidity. So how does it go? It goes, if you're trading internal or taking a trade based on internal range liquidity, your target is external range liquidity. And if you're taking a trade based on external range liquidity, what is your goal? Well, it's reversed. So then you're targeting internal range liquidity. So as an example of this, let's say that price decides to trade based on whatever order flow, whatever, and it decides to trade higher over here. Okay, it's then taken this high over here, it's made this low over here, and probably if that's the case, then maybe somewhere over here this down move and expansion higher could have made like an order block over here, or a void or something, and it's taken the external range liquidity of this swing high, so that if price then decides to trade into the external over here, either you're going to sell and price is going to, you know, trade back to the internal of the void or the order block if you're selling, or if you're buying, what are you doing? Well, then you're taking the liquidity of that external range liquidity. So either you sell into the void closure, you sell into the order block retest, you're selling into internal range liquidity from an external perspective. And if you're not selling and you're waiting for a buy based on the higher time frame buys, maybe you're trading internal range liquidity to external range liquidity. This is external range liquidity over here. And that is your target for price. Now, obviously, price can continue to go much higher, but that is our goal as traders, to take profits as the market gives it to us, because there's scenarios where, yeah, sure, if you had held on to the trade, you could have paid yourself thousands of pips, but there's other times where if you didn't take off anything, then you, or which would be majority of the time, then you're not paying yourself, and you'll get buyers or sellers remorse, and you'll get aggressive, you'll start revenge trading. So the goal is to make money or take money as the market makes it available to you. Is there any questions currently about what we're discussing here about this order block structure and internal, external range liquidity?
No, I got it.
You don't have a question, Manuel?
Yes, I do.
Oh, you do? Okay, go ahead.
So when you talk about internal and external liquidity, we can say that from a swing high to the swing low, it's internal liquidity.
Essentially, yes, but that's a very short and abbreviated version of what it is. So if I draw this out here, let's just move across here. Okay, on a daily time frame, the chart looks like this, right? So let's say it makes a swing high, and we don't see it on the daily daily chart, but on the lower time frames you will see it. So all that you see on the daily is price doing something like this, and then it just sells, and then it stops selling, and then it starts to, you know, move higher. Okay, what you don't see on the daily, okay, obviously there's a swing high here, and then now it's formed a swing low on the daily. Okay, so this is the daily over here, right? And on the daily, this is external, right? Which is also this external now, because it's made that swing low. But this is a daily chart. So if we were to come to say like a 1 hour chart or a 4 hour chart, this massive move from this swing high all the way to the swing low, for price to get there on the lower time frame, may have looked like this, right? Maybe a bit of a consolidation, and then expansion, and then maybe something like this. Because price doesn't always just move in a straight line, right? Although eventually it did get both of these time frames made the swing high here and the swing low here. Okay, the daily's got external at the top and external at the bottom. Okay, so it's daily external, right? But anything in between for this daily, this whole price action move over here, this is internal range liquidity of the daily chart, right? Agreed?
Yes, agreed.
Okay, so then what that means for this time frame over here, and I'm not going to put a time frame attached to this move over here. I'm not going to put a time frame associated to this, because whatever time frame you look at, whether it be a 4 hour, a 1 hour of that daily, okay, all of these over here is going to represent liquidity points, whether it be internal, external. Okay, so if price over here trades higher into this zone over here, for example, this may be a 15-minute external range liquidity. It may be a 1 hour external range liquidity, but on the 4 hour, it may be internal. On the daily, it's definitely internal, right?
So you mean it's depend on the time frame?
Yes, you must just understand that each time frame is going to have its own buy side, sell side liquidity. Okay, what you
Yes.
see on the daily is the overall objective. What you see on the weekly is the overall objective of the swing high and the swing low, the external, the internal. But when you go down to a lower time frame, you're going to see a lot of liquidity and a lot of price action of swing highs and swing lows. Okay, and that's going to be like scalping, intraday price moves, where the liquidity is engineered right then and there. It doesn't mean that now, because all of this has become a void by moving down on the daily, okay, that this whole area is going to be retraced over here like this. It doesn't mean that. What it could mean, though, is that this is a daily over here, and maybe over here is some kind of order block on the daily. Okay, and then the rest of it is a void down. Okay, what we can do with this is say that this daily showed expansion, it showed a low resistance liquidity run, there is an order block over there, but what is price going to do? Is it going to move just in a straight line? Sometimes, yeah, sure. Sometimes, and most of the time, it's not going to move in a straight line. And when it doesn't, you have to say, well, if this is the daily chart, what it looks like, what is the lower time frame looking at, and what is the reactions to price when it grabs these liquidities over here. That's why that exercise, remember, Emmanuel, was to mark up these little swings of price and see the reactions around those levels, because one time frame's internal, daily internal liquidity is another time frame's external liquidity. So price may want to run up here, grab this liquidity on this whatever 1 hour, 5 minutes, 4 hour, retrace, creating new liquidity over there. And then what does price action do from there? Well, it could continue lower to the external range liquidity of the daily, or continue to trade inside of the internal range liquidity and continuously target external range liquidities on the lower time frame, because that's what's happening over here. It's targeting these externals over here. And every time it's doing that, there's these little reversals or larger reversals. That's what's effectively happening in price action. It doesn't just reverse out of nowhere. It's generally taking some kind of liquidity before price expands in a particular direction. And you can go and look that all the way down to a 1 minute chart. You go look at the chart and tell me you don't see internal versus external liquidity structures. But this is essentially it. The daily represents an internal range liquidity over here, and at the top of the swing high is the external of the daily, and at the low of the swing point is the external of the daily. So when we are trading anything inside of this daily that is bearish, we are essentially saying that we need to, if we are bearish on this daily and we want to say trade the void closure or the bearish order block, we want to see price target the external range liquidity over here. And for example, if that's not the case, and maybe price decides over here that it's stopped going lower and it's come back over here in reverse, maybe there's an order block over here on a daily, over here on a daily, or you have both a daily and a weekly confluencing, or suggesting that it should go bullish now and not go any lower, then that too is internal. And then where would we target? External. External would be up top here. So if we're taking the trade idea from here, this would be internal, and you'd be targeting external over here. And that's how essentially the market would move. It goes from one internal to external and one external to internal. Now, yes, sure, there's variations, and sometimes what you think could have been an internal wasn't an internal, it was an external, and it's going to take a lot of practice to get used to this. But that's essentially how the market ebbs and flows intraday, intra-week, intra-month, of where it's essentially going. It trades internal, external, external, internal, and as long as you can understand some kind of concept behind this, then you'll be all right. You don't have to get it to a T, but just understand that one time frame's internal could represent another time frame's external. There's probably going to be a lot of questions regarding this because it is quite important. And if you like to trade, like me, a reversal or a turtle soup, then this is something for you. But if that's not what you like to trade, and you like to trade order blocks or voids or breakers or whatever else you like to trade, then this may not be for you. But it can also be for you because then you might want to know where a potential associated target for this would be. Okay. Does anyone have any questions currently? Ah, I'm amazed. No questions. Roger, you once said to me, I don't understand this internal external. Have you watched the video of the internal external range liquidity that I posted?
Hi, Darren. Yeah, I've watched all of it. I have, and I just stepped away now for about 4 minutes. I had to pop out of the office, so I missed your last 5 minutes that you were chatting. So I'll rewatch that. But in terms of what you explained to me, I understand it much better. You've covered questions that I had around. Now I get it what you mean. But in the daily, just what you've explained, the one example that you just did there with the little purple worm that goes down, that one was for me. You added some info there for me that I didn't understand around external, internal. So now I get it that what's happening between on this daily example between external high and the low of the daily. What happens in between is what you call internal. Um, yeah. So and also on the LR, I understand that a little bit better as well. Some of the questions that the guys asked helped. So yeah.
Okay, perfect. So just to sum it up, guys, let's do it on a higher time frame and get another. Let's do gold, for example. Okay, I know it's if Akron Lives Gold, and a lot of possibly others do also. Okay, what essentially we could say about internal and external range liquidity is the following. Okay, is that if we look at, let's say, a monthly chart first, okay, because doing it from a high time frame is always better than doing it from a 1 minute chart. But what we're essentially saying is that when price makes a swing high over here, and I'm just going to get that in the red so we can all see it clearly. So that is basically having created a high. And then this month over there, specifically this month over here, which was the 3rd, which was March over here. So specifically this March candle over here made a swing high and a swing low. So essentially what we're saying about that monthly chart is that this over here at the top is the high. It's the old high. Okay, this old high is external range liquidity on this monthly time frame. And what we're saying about this old low over here of that monthly old low is also the external range liquidity of the monthly. Okay, so within that month, that is external. Okay, so then when you go down to a lower time frame of, a 1 week, everything inside this monthly candle is internal range liquidity. So what I said was that if this is the monthly internal, and whether we wanted to be a buyer, whether we wanted to be a seller, we're taking internal to go external and external to go internal. And obviously, as you can see here, if we had traded external over here and we tried to buy it, well, we would have just been stopped out. Okay, but obviously we're not just trading external and internal, we're applying, are we in a premium, are we in a discount? Because as we see here, from all the way from this swing high, all the way sort of down this area here, we're in some kind of premium. And yeah, sure, there would have been bounces to buy and things like that, but what we're essentially saying is as long as we're in some kind of premium, and we're targeting external range liquidities in a premium, that is a turtle soup. So we are selling. If we're targeting internal range liquidity in a premium, we are looking to target the external range liquidity. Here's the external range liquidity over here. Obviously also created equal lows, but that's not what we're looking at. We're just looking at the external internal range liquidity structures, which is basically in a nutshell, this swing high and this swing low of, well, not that one, this one probably somewhere over here. Swing high, swing low, and that is the monthly internal range liquidity versus the external range liquidity. So when price trades external, you would anticipate that if it's gone external, it should go back to internal. But what happens? Well, it goes external and then it continues to expand lower. What? Creating a low resistance liquidity run. Targeting what? Well, there's a draw in liquidity over here because there's a void imbalance. There's the consolidation over here because there's a lot of liquidity before this upward trajectory. So below this over here, if you understand anything about an ATM method of ICT, this is a market maker buy model, market maker sell model. And below consolidations sit liquidity. And then that's what obviously what price would target. And also this is an ICT data range of more than, I think it was, getting really technical now, this was like there was a lot of liquidity sitting over here, which was at the time 20, 40, 60, 80, 100 and 120 days ago. So there would be a lot of open interest sitting over here, and then having come from a premium back down to a discount over here. So I'm not going to get into IPTA data ranges right now, but more specifically internal versus external. And you can do this for anything, right? So like we said about the daily, whenever price makes the swing high and the swing low, okay, or the swing high and the swing low, you could basically pick any specific range. I'm not saying which ones you must and which ones you mustn't, but when you're picking a liquidity point of a daily or a weekly or a 4-hour, you're looking inside that internal range and potentially saying what is the bias, overall bias, because if the overall bias is bearish, you're looking for a premium. So where's your premium? It's at your old high or above the old high for the buy side liquidity, or an internal order block, which is internal range liquidity idea. And if that is the internal range liquidity, then you're looking to target external range liquidity. So for a long time, then price, if we see here, decided to make that low. Okay, and from this low, it obviously consolidated here, but from this low to this high, basically over there. So if we mark that out, we could say we were working then within that range. And then we took this high and we took that low. And then we divide that range and we say, well, this range over here, everything in between above here is a premium like this. And then now we say that that whole zone is a premium. And then let's just reverse that. So everything here, this is obviously based on our structure over here. This is the swing high, that's the swing low. And we can remove this fibs. So we know that this is a premium of this swing high and this swing low, and it's consolidating. So if the bias tells us it is bearish, we are looking inside over here for what we can sell. So if we're looking inside here, we can see old high, order block, void, old expanded. Every time there's a low, daily low, it's creating low resistance liquidity runs. So old high, old low, premium, equilibrium. So if we're a seller, we're selling something in premium. If we're selling an order block, we're wanting, and it's bearish, we are wanting to trade the internal range liquidity to the external range liquidity. Yes, sure, if you had taken a trade up here, you would have had to sit through all of this consolidation, but just know that depending on what time frame you're trading, you're targeting internal to external. And if you're targeting external, you're going internal. So if you're trying to buy this low over here, and if you did, you would have been stopped out, but let's say you tried to, you'd be targeting some kind of internal over here. There's no reason to buy this yet if you look here, because it's probably targeting these lows over here. There's equal lows, so there's a draw on liquidity over here. So it's very unlikely that we're going to get any sort of bounce before it takes these lows. But I'm just saying that when you're targeting internal, you're going external. And when you're targeting external, you're going internal. Yeah, sure, it can go much more than you predicted it, but just understanding that that is, you know, our baseline. And if you look here, there's actually even a higher time frame. So we marked up over here, this swing high and this swing low as the monthly. But if we look at what we're actually trading in here, there's actually a swing high here, which was not broken, and the swing low over here before price decided to make this expansion and came back down into this order block and then rallied back up, and then you can see price sort of consolidating here. So we're sort of stuck in this range. So what does this suggest to us? That we're in this range, and anything above here is external and anything below here is external. So while we've got many externals and internals, we can look at an overall perspective. External over here. I'll show you another example of this. Recently on Euro GBP, I marked this up a while back, and that too. If we look at what price had been doing, what is it doing? It's consolidating over here. So where is of this consolidation the highest high, which is sort of over here in that consolidation? And of this swing high, where's the swing low here? Well, yeah, sure, there's a swing low all the way down here, but external structure is there because it's been maintaining this range over here. And there you can see it expanded here. So boom, what happened? It targeted the external range liquidity over here. So if it's targeting external and we buy, it's also come from a high down to a low. So this would be some kind of discount, obviously not the overall discount like that, but it is some kind of discount. So we could say that that is external like that, and it targeted external. And when it targeted the external, we should look for something internal. So what did it target on the internal? We'll look at this. When it traded over here, what is that? That is a trend line going down over here. That is external on one time frame, but internal on another. So external on this monthly and external to internal. This is internal range liquidity over here. That's a lot of liquidity of that trend line over there. Lower highs, lower lows. That is basically a trend line, if you can see it. Not showing you that it's a trend line because we trade a trend line, but because it's liquidity points all throughout. And then you can see that when it took that high over there, that came from a low to a high, and basically price reversed from that point. Any questions?
Quick question from me, Darren. On that trend line that you've just drawn, that is it just identifying that like the it's not breaking those points essentially, like so that would be points of liquidity.
Yeah, definitely. I didn't trade it based on the trend line, but I traded based on the fact that there is liquidity as people would see the trend line, the overall market sentiment. Because remember, not everyone trades ICT, right? There's hedge fund traders who trade stochastics and moving averages, and there's what you see on YouTube is done. People make money with moving averages, trend line. I'm not saying that everyone must trade ICT because that's the only way you make money, because you can make money anyway. You can make money with trend lines, moving averages, whatever you want to use. And that's the majority of what people do use. And it's just the fact that they're consistent and they do it consistently that they get the results they get. And all that I'm saying is that, well, we know that that's a trend line based on what a trend line is. And we're not trading it because there's a trend line. We're trading it because or we're buying into it because there's liquidity there, or once that sort of trend line has taken all of the liquidity like we see there, it then reverses. It's bullish, but it reverses to go in the opposite direction. And actually over here, I drew this out. So over here, there's actually a reversal over there. And there's a reason for that reversal. It doesn't just start to trade higher here for nothing. But if we go look at the 4-hour time frame, there is equal lows over here, somewhere around there. Look to the left over here. Over here, there we go. That one there. So there's equal lows here. Yeah, sure there's a low here, but there's equal lows here. And then what did price do? It trades into those equal lows, consolidation, expansion, reversal below lows, and then boom. And then what does it do? It targets the opposite end, which is this buy side liquidity. That would be then pending sell side liquidity that has not been taken over here. but it did take all of this consolidation there and over here. So you can see that it consolidated, expanded, reversed below old lows in long ago, and then boom, price targeted over here. So if we were to see continuous bullishness, we'd want to see possibly internal range liquidity taken. So we could go down to the lower time frame and say that these are fine to raid, like this swing low is fine, this swing low, oopsie, this swing low here is fine. So all of this can be taken. Price can still go lower here to target this internal range liquidity. But if it goes external here, we could say that it's targeting longer term sell stops, and therefore it's tipping its hand that it's broken structure. Okay, structure is basically where the liquidity is. Okay, so we don't take trades at the low here. If it is going to break here, then it breaks and then it retraces, then you sell. Or it blasts through and creates a low resistance liquidity run over here. The fact that if you look here, it did have liquidity here. It did look like a low resistance liquidity run, but then once it grabbed that liquidity, it immediately took out these highs over here. This is sort of where the breaker would come into the mix and the mitigation would come into the mix. Not right now, I'm going to tell you, but essentially you'd be able to design sort of a setup using internal, external liquidity concepts, whether it be order blocks or voids or whatever the case would be. But that's why we call it like, you know, the anatomy of order blocks. Okay, because there is an order block, but there's mitigation block, breaker, reclaimed, you know, vacuum. There's many types, rejections. But if we understand sort of where we're going, what kind of structure of liquidity it is, then we can sort of trade anyway once we understand that whole liquidity concept. Okay, because we're not trading trend lines, moving averages, we're trading based on what we see in terms of liquidity. Okay, and if we can understand or have some kind of groundwork that's laid out for what is internal and what is external range liquidity, then it's going to help us a lot. We don't have to trade it, okay, but we must understand it. And if we can understand it, then it's going to substantially elevate ourselves to see what we are seeing on the charts. Okay, so to wrap up the order block over here, I'll send you guys some more videos on, you know, each of these items, because they do take a long time. But really what's important is the internal versus the external versus the internal. And there you should have a lot of questions, and if you grab it straight away and, you know, understand it, then great, good for you. But sometimes it's quite a difficult thing to either explain or to understand from, you know, the mentee perspective. So like, you guys might have a lot of questions, or maybe not. It's really up to each individual to see what they need to see or don't. But there is a little tip in terms of an order block. Okay, we're going to have questions now, guys. I see your hands up. If you're trading an order block and you take a trade on an order block, ICT recommends that what you can either do is take profits at the external range liquidity, because the order block would be the internal range. So you can take profits at the external range liquidity, or it's going to be 3 deviations of the order block. So like, for example, let's just draw it out here quickly. Okay, so let's just draw the structure, something like this, some random stuff. Okay, and let's say there's this like down closed candle sitting over here, and then this up closed candle, so it makes like an order block over here, and then we draw out the order block over there, and we say that's the body to the body, and then we're basically drawing 3 of these boxes is our target for price. So if this is a bullish order block and we're buying this, so if price was to retrace, boom, we get in, and now we are sitting here. So we are expecting prices to go higher. If we have chosen either to have a stop just below the 50% or below the low, that's up to us, or whatever our expectations are for stop loss. But in terms of goals for targeting, you're going to do 3 deviations. So this is deviation 1, and then basically you draw this box out again. So there'd be like order block 2, for example. You're basically just measuring the range from the body of the high to the low of the body, not the wick, and then you're counting 1, 2, 3, and then you basically say somewhere over here would be my goal for price. So it would be number 2, and then that'd be number 3. That's sort of the we could say tip that ICT gives us. So if price like retraces here, and we take the buy based on the order block. We either are targeting this external over here, or we are taking profit somewhere inside of this box number 3, which is the third deviation of the size of the order block. So whatever size that would be from the open to the closing price, depending on if it's a daily, a weekly chart, a 1 hour chart, a 5-minute chart. Obviously, you should be using some kind of higher time frame, like 1 hour, 4 hour daily to measure the order block. So if you're using a 1-minute order block, then you're going to get, it's not very realistic. Okay, guys, Thivakaran, I see your hand is up. I think I want to take a 5-minute break, guys. I need some coffee, yeah? So, okay, so what we've said about the order blocks, what we've said about the order blocks is basically that it's either some kind of internal or some kind of external. Specifically, order blocks would be internal range liquidity, and if that is internal range liquidity, we are looking to target external range liquidity. Obviously, our ideas will change based on, are we trading a liquidity pool, because that would be external range liquidity, and then we should be targeting an internal range liquidity pool or institutional reference point. Okay, but that specifically was the order block that we just covered, and I'm going to move on from the order block onto the mitigation block. So when we look at those ideas, okay, and I draw this out over here.
Aaron, sorry, we can't see your screen.
Yeah, 1 second.
Okay.
Okay, so you should see my screen now. And so if price decides to go higher over here, right, and it's going higher and then it stops going higher and then goes lower over here, what we could essentially say is that over here sits the old high, over here sits some kind of order block potentially over there, and obviously we'd mark up either the 50% of the order block or the opening price of the order block, and if that's the order block, then possibly somewhere in this region over here would be some kind of expansion, which would be the void or the fair value gap that was created. Okay, so depending on how far price decides to go lower here and then stops and starts to retrace over here, we would say that over here is again the external and the external. So this is the old high, and then this would be some kind of old low over here. So we've got some kind of range we're working in now, and from this range we are working within is internal versus external. Sorry guys, just hold on 1 second for me. Okay, so basically this is the old low, this is the old high, and we are saying that from this old high to this old low is the range we are currently working in within, and over here sits some kind of equilibrium, and anywhere above this equilibrium over here, between the old high and the equilibrium sits our premium range over here. Okay, but now specifically looking at what this means is that this is our PDA, which is referred to as our premium discount array, and we know that each element here is made up of, or this whole structure is made up of each individual element, like the old high, like the order block, like the void, and now the introduction of the mitigation block over here. But as we see that if price did something like this from that low, okay, we would say that over here is the mitigation block, and we'll get into exactly how it looks and what it looks like and how to identify it. But we'd say that this is some kind of mitigation block, maybe on a lower time frame or something like that, because price decided to, come from a high over there, previous like that. So then we'd say that this is a mitigation block, and that is then lower down in the discount. So the higher we go into the premium of this given range, which is this range here to here, this is the range we are working within. This mitigation block sits lower down in the PDA. So the old high is the highest part of the PDA, and the old low is the lowest part of the PDA. And then obviously above the old high sits the buy side liquidity, and below the old low sits the sell side liquidity. But in between the old high and in between the old low is the swing high and the swing low, the equilibrium, the premium, and the discount. Okay, sits the order block, sits the void, and sits now what we refer to as the mitigation block. But the mitigation block sits lower. Okay, it sits near the equilibrium point. Okay, so it is not the highest or the lowest level of premium or discount. It can still be used to trade. Okay, it's not like it's not tradable, but a mitigation block sits towards the equilibrium more so than the old high, the order block, and the rejection block and the breaker. Okay, so you get equilibrium at the 50% of the range, and above the equilibrium sits the mitigation block, either the bullish or the bearish one sits above the equilibrium point. So what is a mitigation block? A mitigation block is essentially saying that price made a high over here, and then from that high it went lower. So then we would understand that there would be some kind of liquidity over there, and then price decides to retrace, and it's, you know, maybe up top here sits some kind of order block or some kind of void on another time frame. Okay, but essentially what we're saying is that if that's what we identify or candidate for a mitigation block, the only time it will become a mitigation block is when this low over here at the bottom is penetrated over there. So that is what we refer to as the mitigation block, and it is referred to as a market structure shift or shift in market structure. You know, many interchangeable words, as we would essentially call it, but for the purpose of this exercise, we are just referring to it as the mitigation block over here. So what we're essentially saying is that price must break that low, okay, so that if price comes back there, this is the mitigation block, like that. So that when price gets in there, we can then look to sell based on the mitigation block, okay, because anyone who tried to buy there at this point, maybe off of an order block or more trend line retest or whatever strategy they're using, they tried to buy it and it failed to take out this high over here and instead traded then lower. Anyone who would have bought around this region of price action over here would now be in drawdown. Okay, more specifically, institutions, hedge funds, they would be in drawdown, not really retail traders. We don't care about retail traders. So they'd be in drawdown. So the purpose of price coming back here is to mitigate those drawdowns that they are having. So they could like exit that trade at the entry point, for example. And that's why we call it a mitigation block, because they are mitigating those orders that are in drawdown, because they'd be drawdown now having, you know, price gone against them, so they'd be in drawdown. So the reason for price to come back there would be this recuperation of, you know, those orders that were taken there. So either they can exit there and then either redesign their trade setup to take shorts again, but essentially we are saying that they are in drawdown there, and as ICT calls it, would be buyer's remorse, and they are now remorseful for buying because it failed to take out that high. So basically, a mitigation block is a failure swing. That's essentially what we're saying. It's a failure swing. And if obviously this would be some kind of bearish looking idea, it also looks like some kind of M pattern, right? Okay, that's essentially what we're saying, is that we're not trading the M pattern, but we're understanding what the structure on the chart is, okay? Because I'm explaining to you the price action, not the M pattern. Retail traders identify it as the M pattern. I'm giving you, an ICT gives us the understanding of why something is what it is, not because it's an M pattern. If you learn about an M pattern, they just say, well, you trade the M pattern and you look for it on the chart and you trade it. They don't give you the context behind why it's potentially an M pattern. So the context behind why it's an M pattern is the fact that there is buyer's remorse. They failed to take out the swing high, the failure swing, and price returns back to the mitigation block to mitigate those drawdowns or those losses, and then we are taking the trade based on mitigation. So mitigation block is not the highest or lowest level of premium and discount. It is still, however, tradable. You can trade it, especially on a higher time frame. You can use a mitigation block, no problem. You can still use it on like 1 hour. You can use it on a 4 hour, but think of it like support turns resistance, resistance turns support. That's not really what I like to say, but it really does look like that. Okay, we are not saying that, you know, support and resistance, supply, demand, etc., etc. We are just saying why this is the case in the chart pattern associated to this M pattern, and then obviously in reverse it would be some kind of low over here that was created, and then price moves away, so that if price moves away there would be liquidity underneath that low, and if price fails to take out that liquidity, and new liquidity would form above that high, and then if price breaks this over there like that, this over here is our mitigation over there, so that if price returns back, boom, that's what we are essentially saying about a mitigation block. Okay, so let's look at a mitigation block here. A couple of notes. So the market wants to give clear indication. It wants to break structure. It looks like step ladder formation, selling rallies and buying declines. Okay, so you know, you look for a M pattern, you look for a W pattern, and it shows like the structural break. So that's why I said, you know, it looks like an M pattern in a sell setup. It's not because we're trading the pattern, but there's the reason behind the pattern is because they have losses and they would like to recuperate those losses. Okay, so obviously you're going to find more mitigations in a premium to sell and more mitigations in a discount to buy. Okay, also based off of a higher time frame. For mitigation, we are using the old low or the high of the market structure shift to trade back into for us to stalk a setup. Okay, so only when it trades back in there, not trading it because now it's like, you know, support turns resistance or resistance turns support. We are basically trading the market structure shift. So like I said, break of structure, market structure shift. Many people like to use these interchangeable terms, but they're really not. It really just goes by one name, which is that zone over there. So this highlighted pink zone over here at the top is the market structure shift zone over there, and over here in reverse for the buy, market structure shift, which is market structure shift, market structure shift, MSS, that's the abbreviation. Okay, so that is market structure shift, and it is only the market structure shift if and when that failure swings low or failure swing high is broken. Does it become the market structure shift? Only then. Okay, not before it happens. We can predict it to happen based on other ideas, not explained now part of this mitigation, but we're only identifying it as a mitigation unless that market structure shift has been created. Okay, so like we said here, the buyers or sellers inside the failure impulse swing before the market structure shift are in negative, so they need to mitigate their losses over here. So essentially what we're saying is that if we draw this out again, when price buys, and maybe it came from some other whatever swing low, and then price buys and buys, and then, you know, it goes to high, it stops going higher, it goes lower to retrace. Many people would see this as sort of like a bullish scenario, and then they'd buy because, you know, price sort of bought over here, and now they think that, well, they're going to buy again, so they buy it. Okay, and then what happens? Well, this is that impulse swing, and then boom, price drops, and then it creates that market structure shift over there. And then when it's created that market structure shift, we are waiting for price to return back there for then price to go lower. And then obviously if it's in some kind of discount, like the same sort of scenario, price would do this, it would make a low, make another failure swing low, and then boom, price would target that high, making that the market structure shift over here. Because why? They would think that it's going to sell again based on this section over here, so they're going to get in over here to sell, and then price reverses against them, and then they are in losses, so they need to mitigate it. And then this is our mitigation block over there, like that. That is our mitigation block. So that is the market structure shift, market structure shift. Terrible drawing, terrible letters, but you catch my drift. Market structure shift, that is what we refer to as the mitigation block. It is shifting the market structure. Okay. Once we recognize the mitigation, our focus must be on the failure swing high or failure swing low, the market structure shift, and the high or low formed moving back into the market structure. So what does that mean? That means that when we get that structure and we get that failure swing, okay, over here is our points of interest, like this. And when price retrades back into our mitigation, we're essentially saying that from this low that starts to retrace can be used as a profit target, because when it trades into the market structure shift, we would want to see price return down here, and I don't know how big of a swing that would be, a couple of pips, couple of 100 pips, 1,000 pips, I don't know, depending on what time frame you're going to look at it. But we are saying that this is our designated zones over here, and if we are selling at the market structure shift, the reasonable expectation is that somewhere within this price swing from this high over here, from the mitigation of entry, somewhere in between here would sit our stop loss over here. So somewhere in between over here. Obviously this should be a bit bigger, otherwise that would be a terrible risk reward. So something like that. Okay, and that would be our profit targets. So if we are trading at the mitigation, we are using this as for no reason to price, for price to return back over here. It should not return back here. So we can say that somewhere in here we can use, maybe there's an order block we can put our stop loss at, or maybe a void was closed and then we sell and then we put our stop loss over there. There's many expectations as to what we can use to place a stop loss order, but essentially we are taking the trade. If we are taking the trade at a mitigation block, we are taking that trade, we are selling it, and we are putting our stop loss in between our entry and this recent swing high over here. Because this failure to take out this high, so this is number one high, that's number two. So number two's failure to take out number one, there's no expectation that price should need to take the liquidity of number two over here. So that's why it's sort of relatively, when I say relatively, it can go against you, obviously, but just understand that if we are trading based off of mitigation, number two could be the reason as to why we want to take the trade. Now, obviously, if this is a daily structure and it's a daily mitigation, the difference in price from the market structure shift, this little purple zone here, all the way to the swing high, might be a huge amount of pips. Okay, so if we're taking, like say, a weekly mitigation idea, a daily mitigation idea, and then we're executing on a 1 hour or a 4 hour or a 15-minute based off of that higher time frame mitigation block, it's not always required to put your stop above number two, because that would be a massive stop loss size. So you can use something in between. You'd be using the higher time frame mitigation and the fact that it is daily or weekly or possibly 4 hour maybe. So there wouldn't be a reason for price to return back here. And if you're taking it off of the daily, then somewhere lower than two could be your sort of stop loss placement. There wouldn't be a need to put it all the way at number two, especially if it is a higher time frame, because that would represent a huge amount of pips. So recently there was one, I think it was on GU. So let me just have a look here. I think it was on a daily, or maybe a weekly. I can't remember. Okay, yeah. So over here, weekly, right? So we would say that there's mitigations all over the place. So like here would be a mitigation over there, and then price trades through it. So shift in market structure, prices return back over here, and boom. Basically, if you put your stop above here, sorry, more specifically, let's just put a line there rather. This over here would be a mitigation. This too would be a mitigation. So there'd be mitigation there, mitigation there. But when it trades through first this one, you can see it doesn't penetrate that high. So over here, from that low to this high could be like 300 pips, and then from this low to that high would also, when it trades back in here, also huge amount of pips. So it's in regards and relation to the time frame that you're using. You're basing the idea off of a higher time frame mitigation, but you can't be expected, if that's a weekly mitigation, to put a stop loss of 300 pips only to catch 300 pips, because then it would just be like a one-to-one. So if that's a mitigation block, let's specifically use this one. If this one over here first is created, it trades through it and then sort of retests this zone over here by trading through this low. This would be your mitigation. This whole area would be that mitigation. But in regards to entering somewhere over here and putting your stop, that's quite large, so you'd have to narrow it down. Yes, it's a weekly mitigation, but you could find something on the 4-hour or the daily to place a stop loss at, to narrow down that stop loss. And then sort of there was another one over here, so failure swing high to take out any of these other highs, and then it sort of just breaks. So this would be sort of the area of mitigation. Yeah, you can see that's quite large. And from here, let's just take, if we were entering, trades lower and then it trades back into it, and if we enter down here to here, that's 500 pips. Okay, so again, you wouldn't necessarily do that, but what we could say is that it's going to have difficulty now that it's broken and shown a market structure shift again. It's very difficult for price then to come back there. It's going to take a lot of money. And what we could do with this is that, yes, it's a mitigation block. So if we draw that out, there's our mitigation block over there, like that. And then we'd use something else once it trades through here to take an entry off of this lower area of this mitigation. So it's a weekly mitigation. But if we come down to the daily, when it breaks, we could use something else. So, watch price retrace, and then, you just wait and you watch this consolidation, and then you just wait for like an entry, maybe like a turtle soup over here. Or maybe if this order block was traded through and then like a retest of this bullish sort of zone over here, hopefully you're catching my drift. You are marking up a weekly or a daily mitigation, and then you're going down to a lower time frame. It works really the same, like if it was a 4-hour as well. This would be a zone of mitigation over here, where you can see there's a failure swing here. That would be some kind of mitigation, and then this whole zone is our mitigation over here. That's quite a large zone to mitigate. So if we were entering sort of at the retest of this mitigation, all the way to this high is 130 pips. So again, you want to sort of narrow down your expectations. Yes, it's a mitigation block, but you want to narrow it down by doing other entry protocols as well. So it's a mitigation, but on this 4-hour, there might be 1 hour as to why price may want to trade into somewhere into the mitigation block. So here we can see like inside this mitigation, there's actually also imbalance of price because it was efficiently traded over here. There's an inefficiency here, a little bit high up in the premium, but initially there's this inefficiency here and a little bit here that was filled, traded a bit lower, and then it retested this mitigation, which is also, so like you're combining the fact that it's a mitigation with the combination of the fact that there's another confirmation here, like a void that needs to be closed. And on top of that, maybe in that zone, something else exists. So if we marked up, like, for example, this void over there, now we've got a void and a mitigation. And then if we go to like another time frame, you know, to retested that zone and then price traded lower. So it's it's difficult to say you must use mitigation and avoid. You must use mitigation on a weekly combined with a 4-hour, you know, rejection block or 4-hour order block. You're sort of combining something on the higher, something intermediate, and then you are using that as your entry. So I'm not saying it's limited to mitigation blocks. It could be mitigation block with on a weekly with a 4-hour bearish order block on a, you know, lower time frame. That could be like an entry protocol for you. Or if you prefer waiting for price to trade above an old high, that too can be an entry for you. So as long as you understand what a mitigation block is, how you combine it with entry later on is entirely up to us as, you know, traders. So that's what I have to say about a mitigation block. And like we said here, we're waiting for the market structure shift. We can take a look to take an entry at the market structure shift and failure swing low. So like I said over here when I drew this out, market structure shift, and then our goal would be to target this recently created low over here. And why? Because like I said, when we've got the old high, the order block, the void, then, you know, we're already sort of at the equilibrium point. So we're not really at the highest level of premium or at the lowest level of discount. So our goals for profits can't be this huge amount unless it is backed by something of the higher time frame. But generally speaking, if you're trading from a mitigation, your objectives shouldn't be thousands and thousands of, you know, price percentages in points or pips, right? So that's the goal of the mitigation block, is to mitigate the losses and then either continue a specific trend, and obviously coupling it with like a, you know, weekly order block with a 4-hour mitigation and like a low resistance liquidity run. You can see what the market's doing, okay? Because it could continuously make these you know, low resistance liquidity runs, and then every time over here it's basically breaking over here. These are mitigation zones over here based on either lower time frame or higher time frame, depending on what it is that you like to see. Any questions, guys, regarding mitigation blocks?
Hello.
Yeah, Manuel, go ahead.
It's mitigation block always responsible for the shift of the market?
Is it always responsible?
Yes.
Well, there's also a breaker, which we haven't discussed yet. So a breaker
No,
can
I
also change like the direction. But no, market structure shift isn't always responsible for the reason why market structure shifts. Yes, the market structure shifts when we see the market structure shift based on what I've just shown you. But in terms of, you know, at the reversal point of the exact price where price reverses isn't always because of the mitigation. So like we can't say that when we saw price over here on the highest high on GU over here, we can't say that when it traded here that this was a mitigation block or this was because of the market structure shift. There's another reason why price specifically traded to that exact level. And only when we get the market structure shift can we then use the market structure shift. And the only market structure shift over here, okay, because this here is not market structure shift because this high was taken by this high over there. So that is not market structure shift. The only reason why this would be a market structure shift, or sorry, the only reason we would see a market structure shift is when we get a sort of a failure swing. So if we look here, price made a high, and then when it goes down and tries to retrace back up and fails to retrace back up, then only do we get the market structure shift. The market structure shift is different to the breaker. It's not the same. The breaker and the mitigation block is two different things. So specifically, the mitigation block is over here when we get price making the high, it tries to make a low, and then it fails. So when it does that, sort of this guy over here is telling us that this tried to retrace and failed or even over here, depending on which one you would identify. But essentially, we're saying that anytime it's going lower, it should then go higher, but it's failing and it's breaking. So it's shifting the market structure. Does that answer your question, Emmanuel?
It does a bit because about mitigation and the break, I'm a little bit confused on
Okay, let me
what's the
go on.
difference between them.
Okay, no, that's fine. So I've told you what mitigation is. Now I'm going to tell you about the breaker, and then you can decide if that answers your question. And if it doesn't, it's fine, because then you'll go and look for breakers in your charts and look for mitigations in your chart. And then next time when we meet again, you guys can basically, have drawn them out, send me some charts. Okay, so let's go on with the breaker, and I'm sure that would hopefully assist in clarifying what the difference is. Okay, so that was your mitigations, okay? And then obviously there's a little hint here that buyers and sellers remorse over here, buyers and sellers remorse to liquidate losing positions. Favorable conditions for these would be a low resistance liquidity run. That's why you learned about a low resistance liquidity run, so that when you see it and you couple it with like a mitigation or an order block, it helps you. Okay, but let's move on. How to see breakers. Okay, it's very similar to a mitigation. The difference with breakers is how the structure would be the turtle soup it creates and the breaks, the swing high generated by the turtle soup. Okay, so let's just draw that out quickly. So this would be what it looks like. So this over here, there's this swing low, and then there's this swing low, and then there's this little guy here. Okay, below here would be liquidity. Okay, and the moment that liquidity was taken, because now with the breaker there must be liquidity, so the moment this liquidity over here was taken, that becomes the breaker. Notice how there's no, failure swing here, but turtle soups this low. That's the real difference with a breaker. There must be some kind of liquidity grab and reversal for there to be a breaker. Whereas with the mitigation block, we are looking for the identification of a failure swing. So the difference in terms of mitigation would be if price sort of did the same, relatively the same kind of thing over here, made a swing low over here, there would be a failure swing here in this price action. Whereas over here on the breaker, it's raiding the turtle soup, or the liquidity rather. And then this swing high here is becoming the breaker. Whereas this is becoming the market structure shift. That's the difference. The one is grabbing liquidity and reversing, and the swing high is becoming the breaker. And the other one is not so much regarding the liquidity, but rather the failure to grab liquidity is becoming the mitigation. That's the big difference between the two. One is grabbing liquidity and the other one is failing to grab liquidity. That's the difference. So with a breaker, we want to see the market structure shift being traded into after a turtle soup. So like we said about that swing, that's that market structure shift that we spoke of. So if it's bullish, the high in between two lower lows. If it's bearish, the low in between two higher highs. Hopefully that resonates with you. The high in between two lower lows. The high in between two lower lows. The high in between two lower lows. We are right there. That's the high in between two lower lows. A lower low and a lower low, and the high in between the two lower lows. Right there. That is the breaker. That's how to see it. And then in reverse, the low in between two higher highs. right? Simple. That's all it is. What happens? It goes up, it retraces, it goes up again, grabs the liquidity of this high, and then reverses. Boom. Breaker created over here. That's the breaker. Why? Because there's a liquidity grab. That's a breaker. This is mitigation. Breaker, mitigation. The breaker grabs liquidity. The mitigation fails to grab the liquidity. The breaker is sort of using the same as the way that we think about the mitigation in terms of the structure part of things. However, the one grabs the liquidity, the other one doesn't. You see the difference. Hopefully you see the difference, because that's really what separates the breaker from the mitigation. Breakers are generally better to trade because they are a bit higher up in like the premiums or the discounts, whereas the mitigations are a bit lower in terms of our PDA and how that's structured. You'll see the overview of the PDA later on when we understand all of the different components. But that is the key difference between a breaker and a mitigation. One grabs liquidity and the one does not. So this one fails to grab the liquidity of this high and then breaks the market structure or the shift in market structure shift, whatever interchangeable term you want to use, but I know it as market structure shift. That's what I personally use. If you want to use something else, that's up to you, but that is what I learned, and that is what ICT teaches: market structure shift. MSS, market structure shift. Breakers are also mitigating losses. So just like mitigation block was to mitigate losses, well, anyone who would have bought over here and price now decides to go lower here, they would be in drawdown. So what would they do? This would be that breaker. So they'd have to mitigate their losses by retracing back there, either exiting those positions because over here it failed to do what they thought, being bullish, and over here price is mitigating, and then price should essentially go lower. So our attention is this low over here as a potential profit target, or depending on the price action, maybe some other kind of institutional reference point, be a void, order block, or whatever else you would find on another time frame or the same time frame. But essentially either the recent swing low or recent swing high would be the goal of price for trading a breaker. That's how we would trade a breaker. Okay, so with a breaker, you can come and read through these anytime, but like I said, there needs to be some kind of turtle soup for a breaker to form. Okay, the swing high or low of the impulse leg to run the stops will need to mitigate. That's that swing low that we just suggested. The turtle soup above the high and low shows a shift in structure and signals a buy-sell program dependent on discount or premium ranges. So obviously, depending on what time frame you're looking at, but essentially there will be a premium and a discount and a breaker in between. We should also see additional low resistance liquidity runs once that breaker is formed, because then they've come from a premium, they've grabbed the liquidity, and now it should just run out all of those liquidity points. So guys, that's it. It's simple. I'm going to send you more videos on breakers and mitigations, and you can go and watch them, but your view is to just practice these, and that's your lesson for today. Order blocks, what to look for, internal, external range, breakers and mitigations. And that would be it, guys. So go practice it, and I'll send you some more videos on all of those ideas.